welcoming on board Dharmesh Kant as Head Equity Research at Chola Securities joining us this morning. Dharmesh, let me actually start off with your take with regard to IT and what and plenty of developments there, right? I want to first focus in on the rate cut, the likely outlook, the change in Fed chairman, I beg your pardon. What could that bode with regard to IT, and does your view change in any fashion given the kind of commentary as well as the stimulus that has been announced?
Yeah, good morning, Harsh, and good morning to all our viewers. See, I mean, the rate cut, our memory is very short. If you go back 2 years back, the only sound and narrative from all the IT companies was that if the rate cut is going to happen, it will increase the discretionary spend. So last 2 years, we have seen a series of rate cuts coming from the Fed governor, almost 1.75 basis point. I mean, 175 basis point, that is 1.75 percentage point of that has happened, but nothing has changed dramatically on the IT companies. Their revenue growth continues rapid, and discretionary spend has not gone up to their liking. It's almost a mid-single digit kind of a trajectory. And recently, Coforge did a honest meet, and there the management abstained from giving a guidance for the next year. And that was a bit perplexing and surprising, given the fact that Coforge and Persistent both have been consistently giving a better set of numbers on the mid-cap IT space. And then when you shy away from committing things, that means things are not very clear out there. So IT itself is going through a lot of disruptions. AI itself is a disruptive prophecy going out there. So we will see a lot of changes happening in the IT space. The best IT companies can do is sustain this 4-5% kind of a growth trajectory. Currency tailwind is definitely there. We are playing. That is playing out in most of the large cap IT plays. I think that's a trading bet one has to take on the large cap IT space. So Infosys, TCS may still gain 5-6% from where they are currently going into the earnings of Q3. But we have to wait and see the management commentaries coming out. To my mind, structurally, nothing changes for that space. As far as US is concerned, the rate cut is auguring well for the mainstream economy. And they are adopting AI in a big scale to get the efficiencies in place. Even IT companies are adopting AI. So this disruption will take 1.5 years to 2 years. Having said that, I still believe in mid-cap IT space, Coforge, Persistent still makes a good buy out there. One can look at them from at least a 6-month kind of a view is there. Then I think they are better placed because they are into the servicing part of the IT space rather than the product part. And that is where the traction is coming. So net a trading plays on the IT space, but fundamentally, structurally, as you asked me, I think nothing has changed. It's status quo on the ground level.
Well, Integlo, Vivesh, is going to be the stock to look out for, given that they've set out their recent guidance cut for the third quarter of FY26. They've revised their capacity growth forecast for Q3 from the earlier high teens percentage growth to now high single to early double-digit growth because of the operational disruptions and flight cancellations. The revenue impact also, the airline is expecting a mid-single-digit percentage downward moderation in their passenger unit revenue for the quarter compared to its earlier forecast, which was from flat to slight growth. Dharmesh, hi, morning. How is it that you're reading into Indigo's commentary and whether or not it's already baked into the stock price?
Yeah, good morning, Aisha. I mean, a lot of disruptions are still pending for Indigo. We are not done yet on that front. And what we are talking about is the near-term pain, maybe a Q3 and Q4 kind of a pain in the revenue and the profitability. Let's not forget Q2 was very bad for Indigo with a dismal 3% kind of an operating margin. And this is happening when the tailwinds of currency, of the crude oil is playing out. Currency has played a bit negatively for them. But the larger question to be answered for Indigo is they had a huge capex plan, acquisition of aircrafts and everything lined up for the future next 2-3 years. So even that will undergo a scanner since what kind of allotment they are going to get, what are the flight schedules they are going to get, what are the permissions they will get for flying the new aircraft. So I think many problems, structural problem will be there for Indigo on the balance sheet part, and whether they are going to defer the deal and how much hit back of they are going to take on the cost fund if they are cancelling a few of the acquisition of aircrafts, because pilot shortage is already there. So to my mind, even if there is trading bounces, it can best play out for trading bounces. Avoid it for at least 2 3 months till the entire clarity comes out. Structurally speaking, going by the DGCL rules and whatever data we have in our hand in the pilot supply, I think 15 to 20% is the likely cut on the growth aspects of Indigo on the revenue and the profitability front going forward for FY 27 and 28. 2 years will be a difficult year for Indigo to manage, and by that time, after that, we'll see how things are shaping up.
We'll see how that plays out. Dharmesh, you have a view with regard to metals. We've seen a bit of a flattish move on the metal index, at least over the last month or so. You believe that this is just consolidation and could be an opportunity to bite into some of the names? Because when you're looking at pricing, it's looking pretty decent, right? Any headwinds you're seeing?
Yeah, definitely, Harsh. I mean, we are not seeing any headwinds out there, barring a Tata Steel, which is a complex case to study because they have a European exposure, and there the problem is there. Entire debt burden is there. Thankfully, all these announcements, major announcements, were for domestic consumption, and eventually these will be, EPS accretive going forward, maybe from FY 28, 29 onwards. So, I mean, the rebalancing in Tata Steel is shaping up well. Elanch's Spark can itself go to 10 million metric tons per annum. That's the expandability capacity they have. But having said that, I mean, the metal space, if you look at it, it's a volatile space only for the rewards from the trading perspective. But if you're a long-term buyer, I think there's plenty of value out there, maybe in a Hindustan Zinc, which is the largest producer of lead, zinc, and silver in India. Still, the valuation has not, peaked up. Hindalco is doing pretty well, though they had their fire issue problem out there, and the expansion plan is out. They've outlined that. But eventually, I mean, going by the way the traction is happening and all the rate cuts coming in US again, it will benefit with the LRS and Novelis, counterpart in the US. So Hindalco looks pretty good. And the ferrous space, Jindal Steel and JSW Steel are two counters which we think have plenty of value to add out there. The only thing one has to focus on if you are playing a ferrous space, play on the domestic front, because China can dump and disrupt the international market in a big way. They are already, curtailing on the steel production because of their, consumption concern on the international scene. And domestically, all players are looking good. So a basket is recommended, and maybe Hindalco, Hindustan Zinc, JSW, and Jindal Steel and Power one can play out. Vedanta is one which is the most undervalued company under the basket, but only the problem is with their promoters. They are very tricky, and you never know what kind of announcements will come through and may eat into the profitability. Otherwise, if you are going to give the benefit of doubt to the promoters that eventually either through dividend or through value addition it is accretive, then I again think it's a very good structural play to be into. So metal as a space is looking very constructive for next 1 year.
The other one, Aisha, is Ashoka Buildcon.
Yeah.
They've won that near 2,000 crore order. And viewers, you have to keep this in perspective. It's not just Ashoka Buildcon, which has won the whole thing. There's a JV below Ashoka Buildcon and 51% owned by the Adani Group, 25 to 26% owned by Ashoka Buildcon. So technically, just around 500 crore of revenue accrues to Ashoka Buildcon as a result of this. It's with regard to the Mithi River Development and Pollution Control Project. And of course, this is a positive because the BMC has awarded this contract and likely to be executed. And, Dharmesh, what do you make of this entire infra play? We've started to see an uptick with regard to infra orders coming through. Do you believe that there are any plays, in your view, in terms of favorites that an investor can play with regard to this infra theme which is playing out?
Yeah, I mean, infra largely has disappointed for last 2 years. If you look at the growth trajectory, most of the company delivered around 10 to 12% kind of a growth, and it was not on the higher teen side. But having said that, I think normally second half, and as we end into the December and JFM, January, February, March, the order inflows starts trickling in for the build-up of the next year of execution, and these all order flows are in line with that continuity of the trend which has been there. L&T is one play which we have been liking. However, again, 10-12% is what they have been, delivering. But the order book has grown significantly, and hope is that margins will be sustainable going forward. So that space looks very good. NCC is one play which you can look at. The only problem with most of the infra plays, if I may highlight right now, is the Jal Jeevan Mission, money not coming into most of these players. So the government stopped them and the audit is going on for most of the projects awarded to them. I think slowly even that will come out and that will ease out the working capital problem with most of these companies because of the lack of cash flow from the government. Otherwise, L&T and NCC remains the topic in the space out there.
The other stocks which are also going to be in focus is, just look out for Swiggy, because it seems that their QIP saw 4.5 times demand. It was a sizable 10,000 crore rupee QIP. So that, of course, is one stock which is also in focus. And then Eternal, the kind of grind that this stock has consistently been seeing, and now it's well sub even the 290 price point, struggling at 280, in fact, thereabouts. That's, of course, Eternal in trade for you. Keynes, that continues to be that curious case. Saw a little bit of recovery day before, and then again, it all gets undone. That stock fell another 11% in trade yesterday. And interestingly, it's not Keynes. Look at the pressure that you're seeing on some of the other EMS players as well. So along with it, Dixon, etc. as well have been falling. Dharmesh, you think this Keynes incident is sort of clouding the rest of the EMS pack too?
Yeah, Aisha, in a way, yes. I mean, see, what happened with the EMS pack is they were in a super growth trajectory 3, 4 years back. Almost 100% kind of a growth was coming, and so was the valuation multiples being awarded to them. So whenever, I mean, an HNI or a fund manager, they are looking at these kind of a EMS play, they are looking at super normal kind of a growth trajectory, and they are not looking at 25, 30% kind of a growth trajectory. So I think these companies are slowly grinding down to the normal rate of growth, or maybe around 25 or 20% kind of a growth run rate going forward. So businesses will continue. They will still be continuing to make profit at this growth trajectory. But the valuation multiples, there's a great disconnect. So one may say that if you are delivering 25, 30% kind of a growth, why not 40p multiple is, what's wrong there? But the only point to be noted here is if you want a 25, 30% kind of a growth, so there are plenty of other plays with, larger value out there. Basically, the job which they do is more of a commodity play. There is a very small value addition happening out there, not a very niche technology or patented technology which you are developing. It's just a processing of the PCBs which you receive from overseas. So that's the problem out with this space. Correction has happened deeply. I mean, it may grind out some time, but I don't think a meaningful upside can be there for most of the EMS plays. So value correction will happen, and the EPS and the profitability has to catch up with this value correction. So for next 1.5, 2 years, I think this space is done with. And I can just give you one example. Please do remember Trent, how it has fallen at 5,000. Everybody was saying, still delivering 25% kind of a growth. But from there, it has come down to 4,000, though it's still doing good numbers and expected to do 20% kind of a growth. So these kind of things, plays out, and people who are sitting on the fence with such kind of a news flow, they have booked profit and are out of the space.
Okay, let me also welcome on board Somil Mehta and find out what he's looking to trade. Somil, hi, morning. Firstly, your call on the Nifty, and where do you see acute weakness and strength perhaps persist?
Good morning to everyone. View remains positive on Nifty, Bank Nifty both. Medium term, still on the positive side. There are crucial levels which we need to take a note of, which is 25,640. I'm not expecting markets to go below 25,640 here. That will be a very crucial level to watch out for, which will be a reversal as well. On the downside, if there is a break, then we may slip down to 25,330, but I'm not expecting that. My view still remains positive. We've seen a little bit of weakness in the very short term, but this will be a buying opportunity. My target still remains above 26,300, 26,500 levels in the short to medium term outlook. So buy on decline should be the strategy here. For Bank Nifty, crucial levels. We are still, range bound in Bank Nifty. The yesterday low will be very crucial here, which is 58. 58,860. So that will be a very crucial level. And below that, 40 daily moving average, which is 58,400, that will be a very crucial level as well. But we are in the range. Now, I'm expecting this range to break on the upside for a target of 60,100 and above that 60,500. So these are my levels for Nifty and Bank Nifty. However, we should be more focused on large caps rather than small caps and mid caps. There are a lot of small caps and mid caps which are bleeding at this point of time. So we shouldn't be, catching the falling knife. We should be more focused on sectors like banking, which is performing well, metals, which is performing well as well. Autos have been in a good, uptrend. So focus on the stronger sectors, stronger stocks, which are already in the uptrend.
Right. Okay. That's the take coming in on what the market is looking like. But Somil, any individual stock-specific strategies that you may have?
I have metals and auto both on my list. So metals, Hindalco looks great to me. Hindalco has been consolidating right now in a very small range, but I'm expecting this range to break on the upside. Already in the uptrend, we've seen a sharp correction last week, last to last week, but I think this is a buying opportunity. Stop loss would be around 803. Target would be 865 for Hindalco. The second stock is Ashok Leyland. Ashok Leyland, again, uptrend, great momentum here in the medium-term outlook, support at the short-term averages. Small consolidation is going on right now, but I'm expecting this to break on the upside. Stop loss would be 155 and target would be 168.
Right. Okay. That's the take on what some of the interesting names are. Of course, there'll be a lot of newsmakers as well, which we're going to be closely tracking. There's Swiggy, like we just pointed out. It saw a fair amount of demand for its QIP, Petronet LNG, which is inked that 12,000 crore rupee loan agreement for Petchem and other capex with SBI and BOB. So look out for what those stocks as well are going to do in trade today. And then, of course, this TCS, that acquisition of Salesforce partner Coastal Cloud for about $700 million. That seems to be quite the strategic move. And SBI and BOB as well. They've got the RBI nod now to set up digital payments platforms as well. So look out for what these stocks do. Dharmesh, what happens to the erstwhile PSB story in this market volatility? One has forgotten about that. Do you think there is still merit and value in PSBs?
Yeah, definitely, yes, Aisha. I mean, there's still value out there, and I mean, this is just the beginning of a larger long-term trend in most of the public sector banking space. So, first leg of the rally has already happened. But if you look at, say, Bank of India, for example, is still trading at 0.6 time price to book, 1 year forward, where the bank has consistently delivered 13 to 14% kind of a credit growth for the last 5 quarters, with stable asset quality, stable NIMs, and good, and ratios in place, be it, CET1 ratio or the other provision coverage ratio and all. Credit cost has also not gone up. To my mind, most of the public sector banks are not speed towards, more getting aggressive on the personal loan front. My interaction with most of the management do suggest that now they are gearing up for vehicle loan, personal loan, and the gold loan for into the play. So this will add value to out there. The top picks out there remains, Bank of India is our top pick, followed by Bank of Baroda and Canara Bank. So they would be rated at par with, private sector banks in, say, maybe in next 2 years time frame.
Right. Okay, that's that on PSBs. But Dharmesh, great to have you on the show today. We'll let you go on that note.